With the U.S. markets now closed for the weekend, we can absolutely explosive session for Opendoor Technologies. The stock, ticker OOPN, finished the day at $7.97. That was a gain of 94 cents, or a staggering 13.37% in a single session. This wasn't a low-volume drift either. This move happened on colossal trading volume of over 205 million shares, absolutely dwarfing its recent daily averages and nearly tripling the volume from the day before. The after-hour session saw a slight pullback, but the statement was made. Now, the immediate expectation when you see a 13% surge like that is to look for a press release, a buyout offer, a blowout earnings pre-announcement, a major upgrade. But there was nothing, no formal news from the company. And that's the first reality check. This move wasn't a response to a simple headline. This was a technical, sentiment-driven, and strategic battleground coming to a head. The expectation is that Opendoor is a failed cash-burning iBuyer, a relic of the zero interest rate policy. The reality is that a significant portion of the market, including some very large players, is betting that the narrative is completely wrong, and they were willing to put hundreds of millions of dollars behind that bet on Friday. Let's establish the common ground, the expectation that has defined this stock for the past 2 years. Opendoor has been, for many, the poster child of the iBuying model's collapse. The business was simple: use an algorithm to make all cash offers on homes, perform light repairs, and resell them for a profit. It was a model that worked beautifully when home prices were only going up. But when the Federal Reserve began its aggressive rate hiking cycle, the housing market seized up. Opendoor was caught holding a massive inventory of homes that were declining in value. The losses were astronomical, and the stock price collapsed from its lofty post-SPAC highs to under $1. Analysts, for the most part, have written it off. Even today, the consensus analyst price target is somewhere around $1.50, with many ratings at a firm sell. The expectation is that this company is in a death spiral, a meme stock that retail traders on platforms like the Robinhood app or SoFi Invest play with, but not a serious investment. Here is where that expectation shatters against reality. Friday's 13% surge on 205 million shares was not a Robinhood stock trading retail frenzy. That kind of volume, that kind of targeted buying pressure suggests significant institutional activity. This is happening because the company has been signaling a massive strategic shift that the bearish analyst reports are ignoring. The reality is, this may not even be the same company it was just 60 days ago. First, the co-founders are back. Keith Rabois, an original co-founder and vocal venture capitalist, has returned as chairman. Eric Wu, another co-founder, is back on the board. And they brought in a new CEO, Kaz Nejatian, who was the chief operating officer at Shopify. This is not the action of a company that is winding down. It's the action of a company preparing for a complete overhaul. They didn't hire a finance or restructuring specialist. They hired a product and platform expert from one of the most successful e-commerce platform companies in the world. This signals a reality that the market is just beginning to price in. Opendoor is aggressively shifting away from being a capital-intensive home flipper to being a capital-light real estate platform. We saw evidence of this recently with a nationwide rollout of its agent partner program. This program, which was already showing success in pilot markets, essentially allows Opendoor to partner with local agents, giving it nationwide reach without having to deploy deploy billions of dollars to buy inventory in every new market. This is a far more scalable and less risky model. Adding to this, last month, the company filed to expand its service offerings to the entire continental United States. This is an aggressive, forward-looking move. And let's not forget, just last month, a regulatory filing revealed that Jane Street, one of the world's largest and most sophisticated quantitative trading firms, had taken a 5.9% stake. Firms like Jane Street don't make bets like that on a dumb meme stock. They see a data-driven edge, a mispricing. This is the context for Friday's 13% jump. It was a violent repricing. The stock has been in a volatile, compressed range for weeks, trading between the high 6 range and the low 9 range. It's been a brutal fight between short sellers, who see the awful housing market and the analyst price targets, and new bulls, who see the new management and the new business model. This recent volatility has been amplified by new financial products. Just this past week, a new 2x leveraged ETF tracking Opendoor was launched. This invites even more volatility and algorithmic trading, as it gives traders a tool to make amplified bets on the daily swings. What we likely saw on Friday was a wave of buying, perhaps inspired by the new management's potential, that triggered a cascade. It likely forced shorts to cover, which means they were forced to buy shares to close their losing bet, which pushed the price higher, which triggered more short covering and algorithmic buying. This is a classic short squeeze characteristic, but it's one that is now being fueled by a potential fundamental story, not just a social media trend. This is a very different beast from the volatility we see in Tesla stock, which is often about production numbers, or Nvidia stock, which is about AI chip demand. This is a binary bet on survival and transformation. Many investors looking for investment help or online investment options are probably looking at this stock on their Fidelity mobile app or through their individual brokerage account. What to do? The high-risk nature of this single stock is likely something a Schwab Intelligent Portfolios robo-advisor would avoid entirely. And any Fidelity wealth management advisor would caution that this is pure speculation at this point. This is not a stock for a Fidelity IRA's account unless you have an extremely high tolerance for risk. But for active traders using a Fidelity trading platform or the Interactive Brokers platform, this stock has become a prime example of the tension between an old, broken narrative and a new, unproven one. Let's talk about the macroeconomic reality, because that's the headwind. The U.S. housing market is still in a difficult place. As recent data shows, existing home sales are extremely slow. The market is largely frozen because so many current homeowners are locked into 3% mortgages and are unwilling to sell and buy a new home at 6.5 or 7% rate. This lock-in effect starves the market of inventory and transactions, which is Opendoor's lifeblood. This is the core of the bear thesis. Why bet on a real estate company, even a new model one, in the worst housing market in decades? The counter-reality is twofold. First, the new platform model is less dependent on a high volume of transactions and more dependent on margin and service attachment. They are moving from a high-volume, low-margin business, flipping, to what they hope will be a lower-volume, higher-margin business, services, partnerships. Second, the macro environment, while bad, is showing signs of a bottom. The Federal Reserve did cut rates by a quarter point in September. Mortgage rates, while still high, are off their absolute peaks. If we get any more positive inflation data that suggests the Fed is done hiking, or even hints at more cuts in 2026, mortgage rates will fall. If rates dip back towards 6% or even the high 5% range, that lock-in effect will start to ease. That would be a massive tailwind for the entire sector, and Opendoor, being one of the most shorted and high beta names, would likely react the most violently to the upside. So, what is the path forward? All of this is building toward one single critical date, Thursday, November 6th. That is when Opendoor is scheduled to report its third quarter 2025 financial results. This will be the single most important conference call in the company's history. It will be the first time the market hears directly from the new CEO, Kaz Nejatian. It will be the first time we hear from the returned founders, Keith Rabois and Eric Wu, about their specific vision. The expectation is for more losses. The consensus EPS estimate for the quarter is still negative, though it's better than the same quarter last year. Analysts are forecasting revenue to be significantly down year over year, reflecting the slow housing market. But the reality is that the headline numbers might not even be what matters. The market will be listening for something else. They will want to know the progress of the agent partner platform. They will want to know the strategy for managing the remaining inventory. They want to hear the specific, forward-looking guidance from the new management team. If the new CEO lays out a clear, confident, and credible path to profitability, one that is built on the capital-light platform model, the stock could be completely re-rated. The analyst targets at $1.50 will look absurd. This is what Friday's 13% jump was. It was a massive bet that the new management team will deliver that vision on November 6th, and the shorts are terrified. Here's the engagement command.